first thing I guess what I'll talk about is when underwriting loans, there's 5 C's of credit. I'm sure most of you have heard of them or dealt with them dealing with banks, but so there's 5 C's of credit that all bankers look at when determining loans. The first C is character. Basically what that means is how comfortable is a banker with you repaying the loan. The banker needs to get comfortable with your honesty, your integrity, and that's all kind of stuff that you can't really have a tangible thing to. So what the banker will also do in this C of credit is pull your credit bureau score. That's really the only way a banker can tell the integrity you have with paying back loans, based on your credit score, especially with small businesses. So basically, character, everybody here is going to have it. You'll all check off that C. The second C, when dealing with banking and underwriting, is capital. Now, capital can be 2 different things. First thing capital would be is your net worth in the company. So what a banker looks at oftentimes is your capitalization. So basic capitalization is on a balance sheet, your assets equal your liabilities plus net worth. So if your liabilities are higher than your net worth, then you're what we would call a leveraged company. In reverse, if your liabilities are less than your net worth, you're a well-capitalized company. The higher your capitalization rate, the more likely you are to be able to secure a business loan. That being said, leveraged companies also receive business loans, but the more capital you have, the more likely it is to get that approved. That being said, banks often know different industries. That's one of the great things about banking is I've got customers in all the different industries. So some industries are highly leveraged industries, Like, it's kind of funny. If you look at a bank's balance sheet is extremely leveraged, and we always require our companies to be well capitalized while the bank is leveraged. So based on industry, there's some leeway with that. The third C of credit is cash flow. Basically, are you making enough money to repay your debt? One metric we look at as bankers is debt service coverage. Oftentimes, the industry mark for having strong debt service coverage is 1.2 times. What that means is if you've got debt service of $330,000 a year, we look for your cash flow to be somewhere greater than $400,000. That being said, again, it can be lower. We like it to be higher. A lot of people think that the cash flow is kind of the only thing banks look at. So I might have a customer come to me and say, my cash flow is great. Why wouldn't you give me this loan? Well, yes, cash flow might be great. The other metric is capitalization that the bank looks at. Because an analogy we like to use is you can think of an income statement and a balance sheet as kind of how you're feeling today and your immune system. Your income statement being how you feel today. If you feel fine and you're cash flowing, everything's great. Your immune system, it doesn't really matter what it feels like because you feel fine. The second you get sick or get a cold and you start not feeling well, if your immune system, being your balance sheet, isn't well capitalized and you can't support yourself when you start not feeling well, then it can really go south quickly. So that's kind of the analogy I like to use. It's easy to follow. It's why we like to see both cash flow and capitalization. The third C we like to see is collateral. Complaint I often get, and based on the borrower is, well, you've got enough collateral. Why do you need to margin it? A lot of times, banks will margin receivables. This based on receivables will go anywhere from 50, 60, 70, 80% depending on the industry and the collection rate. Inventory, that's margin as well. Banks don't go 100% on receivables, inventory, and on really any collateral. Because if you can't sell it, we can't sell it. That being said, on collateral, banks like to do working capital lines of credit with short-term inventory needs or receivables, and also we like to do longer financing with being secured by equipment or real estate. That being said, everybody says, the longer your loan, the better for the borrower. While that's true, I would also argue, and this is obviously the banker in me, that you want to make sure you match up the useful life of that equipment or real estate with the amount of time you do your loan for. The final C I have is conditions. And This is tough because oftentimes small business owners and business owners in general can't control their conditions. So that's something the bank looks at. If they like the home building industry, right now it's pretty hot, they might like that. Back when the auto market was struggling, a lot of banks probably didn't like the auto industry. So it kind of depends, but all you can really do is run your company the best way possible, retaining profits, keeping it the company, building a strong balance sheet, and that's what will set you apart when looking for loans. Some of the main takeaways I have is banking is a risk business. So a lot of times when you're getting your loan, you're asking for an interest rate on your loan, what the bank is measuring is the risk they have in that loan. So the higher the risk, maybe the more risky the bank foresees that loan, and the more secure they feel on a loan, the lower your rate will be. One thing I would definitely recommend with everybody when dealing with their bank is open communication. The one thing, whether a loan's going great or a loan's not going so great, the more communication you have with your banking officer, the better things are going to be. If you don't talk to your banking officer except once a year, and when you come to that once a year meeting and you guys lost money last year, you're losing money again, things might get a little hairy. That being said, if you communicate with your banker the whole way through, it's a little easier to have that final conversation and to work through some stuff. Open communication, as with everything, is always the best. The final kind of takeaway I have is to, look at your banker as a partner. Don't look at your banker as someone who you have to answer to or who's always holding you back. Make sure when you think of your banker, he's someone you can call, you can talk to, and bounce business ideas off. Again, one of the best things about our job is I get to work with a bunch of different business owners, a bunch of different revenue sizes, and a bunch of different things going on. So you may be thinking of doing a certain transaction, whether it be treasury stock or purchasing a piece of equipment, whatever it might be. I can kind of walk you through what I've seen my other borrowers do and kind of what might work best. I guess in banking, so there's conventional commercial loans, but then also there's the SBA. And within the SBA, it allows small business owners an easier way to get maybe their first loan or their first few loans to get things started. So kind of the two main loans within the SBA are the SBA 7A loan, which the biggest thing about the 7A loan is it gives the bank a 75% SBA guarantee. So where the bank may require the borrower to have a 25% guarantee or to guarantee the loan, 75% of the loan amount is guaranteed by the SBA, which allows the bank to get a little more comfortable with maybe a new startup business that doesn't have a history of earnings. The second, probably most common SBA is the SBA 504 loan. What this is basically a real estate transaction that allows business owners to purchase a building with less down than maybe they would have to through the conventional banking route. With the SBA 504, it's 504 kind of spells it out. The bank puts in 50% of the loan, 40% is put in by the SBA via a CDC in an economic area, and then finally the borrower puts 10% down, when traditionally on real estate loans, banks will be requiring 20% down. So it just allows the business owner to get into a piece of real estate for a smaller amount of money than maybe initially thought. That's kind of all I have. I guess I'll be over there. My back will be to you right now, but feel free to come by, pick up a card. I'd love to meet with any of you, whether it be a potential loan, someone's kind of thinking through, or just kind of bounce ideas back and forth on different issues. I'd love to be that resource. Thank you.